Hi, good morning, and welcome everyone to our panel on climate change. So extreme weather events are now becoming the new norm, and they are taking businesses, homes, and lives. So climate change is a topic that is very, very prominent in the world, and actually a lot of countries are taking efforts to tackle it together. More than 130 countries in this world have actually committed to net zero targets by 2050, and there are policies and regulations at play to tackle these. So in light of this, corporates would have to take into account these policy as well as technological changes and weather-proof their businesses in terms of physical tail weather risk events. Asset managers, on the other hand, would also have to take into account these in their portfolio company valuations, as well as encourage portfolio companies to disclose more and manage their climate risks. So today on the panel, we have with us two esteemed guests. We have Ms. Lynette Leong, who's the Chief Sustainability Officer of Capital Land Investments. And to her right is Ms. Go Zue, who's the Head of ESG Equities Research at Fullertons Fund Management. So let's start with a quick introduction. So Lynette, what does ESG mean for your business strategy?
Well, at Capital Land Investment, sustainability or ESG is at the core of everything we do. And as we grow our business, we want to pursue profitability in a responsible manner. And that means to contribute to the environmental and social well-being in the communities in which we have influence. And Amanda mentioned about a sustainability master plan. Well, that's a strategy that we have formulated where we've set very ambitious targets for 2030. And we've also mapped out a roadmap, pathways to achieving them. Now, what do I mean by sustainability being at the core? For us, it means embedding it into every stage of our real estate life cycle, from investment all the way to how we operate our buildings. So in investment, every deal that comes through our investment committee would have checked the boxes on climate risks, as well as to meet our sustainability master plan targets. In the design and construction of our buildings, we adhere to our sustainable building guidelines. In the procurement of our different resources, our supply chain has to comply with our code of conduct. And in the operation of our buildings, we ensure sustainable practices and future-proof our assets, and also make sure that our resources such as energy and water are used efficiently. And then over and above that, we also bear in mind the need to reduce carbon emissions. And so we base on science-based targets and to guide ourselves. And I just want to give one example of how we've managed this process with two malls in Singapore. Some of you may have shopped at Plaza Singapura and Ion Orchard. And some of you also may remember that in 2011, there was a major flood that kind of ruined Orchard Road, and many buildings were damaged and suffered badly. And water went into the basement car parks as well as ground levels. And fortunately, both our buildings were unscathed and didn't suffer any damage. And it's because, even though Plaza Singapura is almost 50 years old, we've been doing refurbishment and making sure that we put in sufficient flood mitigation measures. And then Ion Orchard, from the beginning when we designed and constructed the building, we have adhered to our sustainable building guidelines. So all these are very important to us. And in addition, innovation is also very important, and we feel that we need to step it up. And we have launched a Sustainability X Challenge where we globally source for solutions to help ourselves. And also we have a Smart Urban Co-Innovation Lab where we jointly partner with different players to innovate.
Thank you so much. Now it feels so much safer going into a Capital Land managed building. So over to you, Suwei. So we know that Fullerton takes ESG extremely seriously. So what does ESG mean for your investment approach?
At Fullerton, we have a bottom-up, fundamental research-driven process. We embed environmental, society, and governance factors because we believe this is how companies should be evaluated. all our analysts carry out ESG analysis and ratings for the companies we invest in. And we rate these companies on issues which we deem material. And we assign ratings to these companies so that we can compare against peers and across markets and sectors. I would say that our investment process has not changed, but it has certainly evolved, particularly in the way we go about assessing companies. As an analyst, when we evaluate a company's business model, we forecast sales growth, we make assumptions about the earnings potential, we analyze the ability of the company to generate a cash flow and returns. When we think about incorporating ESG, we layer on a different perspective and we question what's a company's right to operate, why it exists, and what kind of impact its goods and services have on the environment, on society, and on consumer demand. And we incorporate this into fundamental analysis across all our funds, not just our ESG labeled portfolio. This means that the questions we ask management of companies such as CapitaLand, where we engage with them, will cover not just the operational aspects, but also cover very specific ESG-related topics, such as what is the impact of climate change? How are you measuring the carbon footprint of your assets? Ultimately, though, our objective remains the same, and that is to determine whether or not we want to stay invested in the long run.
Thanks so much. And it's great to see that both companies are actually taking ESG so seriously and embedding it into your strategies. So there's often a very controversial topic that is mentioned. What's the trade-off between sustainability as well as returns? So we know that corporates, especially in light of the ESG trends as well as regulations, have to invest very heavily. So what do you think, Lynette, is the cost of sustainability to your firm?
Well, let me first start by saying that the cost of not being sustainable is going to be huge. Climate change will leave us or leave the world with a lot of stranded assets if climate risks are not mitigated. So in our business, we actually look at how to measure some of the costs and benefits. I believe that if we spend money at the right places in sustainability, we're going to reap economic benefits. And in economic terms, we classify this as cost avoidance. One example that we have achieved cost avoidance is in the utilities cost consumption. Since 2009, we have achieved $270 million in cost avoidance as a result of reduction in energy and water consumption. So that's a positive. And another positive is that our interest rate savings obtained from the fact that some of our loans are sustainability linked, and when we meet the sustainability criteria, we get a discount of our interest rate. So thanks to our fellow banks. And then another imminent cost that everyone should be aware of are carbon taxes. So all these, we are trying to develop a metric called return on sustainability, and where we are going to form an equation to better quantify the costs and benefits. And we believe that this will help ourselves to make more informed business decisions.
That's very interesting. So Siwei, as an investment analyst, how do you factor these costs as well as ESG factors into your analysis?
On a very high level, we think about it in terms of the discount rate and the cost of capital. Earlier, I talked about how we compare companies and we rate these companies. So in this case, we would assign a cost of capital and compare it across the companies depending on the relative ESG attraction versus its peers. We may also factor in that to the valuation multiples that we assign to the company. Now, on a more granular level, and to address the topic that we have today, when we try to quantify the impact of climate change on the company, we will assess it from the perspective of, say, the different carbon pricing, as Lynette mentioned, about carbon taxes, border tax adjustments, or the use of credit offsets. and what the impact is on the company to reflect the overall economic cost of emissions, not just so that we can account for potential fallout that may arise from climate-related events, such as that it will have the impact on asset valuations, on cash flows, or on credit availability, but also so that we can reflect this in the operational costs that we're using. Let me give you an example. We invest in quite a few of these manufacturing companies here in Asia. Many of them are switching to renewable energy sources. Of course, the short-term and upfront costs will be huge, but we believe that the payoff will be worth it in the long run. So we'll incorporate this into our financial models, as well as any other costs that may arise from ESG factors. This is not an easy exercise to do because many of these assumptions that we are trying to factor in are not well disclosed. But we have an advantage here at Fullerton because the team of analysts who are making the recommendations to buy or sell the stock is the very same team who is carrying out the ESG analysis. Therefore, having ESG well and truly integrated into our process will make our analysis much more robust and informed.
Can I just add that I know we talk about costs all the time, but then there are also value creation opportunities where we are able to derive from being sustainable. So we are at Capital Investment, we are looking at the ability to generate renewable energy and then maybe coming up with a fund that everybody can invest in. And Zue talked about renewable energy, and some of the things that we're also thinking about is that there's a lot of collaboration that's needed, in this entire ecosystem. So one example is that in the production of renewable energy, such as solar panels, it is expensive, right? But we are not in this business, so we collaborated with Samcorp, that is in the business, and they spend the money to install solar panels on the rooftops of our industrial properties. So we provide the rooftops, they spend the money in CapEx, and the renewable energy that's generated is used by ourselves during office hours, and then off peak, it's pumped back to the grid, and then they benefit. So it's a win-win for all of us. And I believe that there is an opportunity for partners to come together for win-win solutions.
That's great to hear, and I love the interaction between the both of you. So we're coming up to our last topic, which is about corporate engagement. So Sue, just wanted to understand, what is your ESG engagement approach like?
Here at Fullerton, engagement is the responsibility of the research analysts and the portfolio managers. And we also have the help of a team of ESG specialists led by you, Amanda, to guide us along the way. I think of engagement not just about conducting research or having a meeting with a company to discuss the business operations. Engagement goes beyond that. We engage with companies with a very specific purpose in mind. We engage with them and we have objectives. We have a set of objectives, and we'll reflect to the management what we think they ought to achieve and how they can improve shareholder values. For example, last year, we engaged with a company which we are invested in. This is a global leader in cordless battery-operated power tools. The company has a climate and carbon risk mitigation strategy that adheres to GRI standards. But we asked them, go a step further and disclose using TCFD framework. We also urged them to set targets not just on Scope 1 and Scope 2 emissions targets, but also to map out their Scope 3 targets. And we'll follow up with them this year after their full year reporting. I think it will be interesting for our audience to also know that we have several different approaches to engagement. The first is direct engagement, where we interact with the companies on key issues, such as the example I just gave on the power tools companies. And this will cover issues beyond climate change, such as board structure and employee welfare. The second form of engagement is thematic engagement, where we leverage the knowledge that our analysts have across the entire investment universe to identify very specific themes. Some of these would include decarbonization, clean technology and energy, as well as financial inclusion. The third form of engagement is collaborative engagement, where we work with industry associations and other institutional investors to have dialogues specifically on ESG issues. In fact, this is something that we'll be making more efforts in because we believe that we can influence change much more effectively as a whole with our peers than as one individual investor. Just one final point I would like to make on engagement is the outcome. As we engage, we need to know what changes have been made as a result of these engagements, whether companies are improving, or they're just simply paying lip service. Many companies have committed to achieving net zero or carbon neutrality, but many of these are long-term targets set for 2030, 2050, or beyond. So it is very important that we track the progress of their short-term goals to determine the credibility of achieving those net zero goals.
Thanks, Zui. Just maybe one or two sentences on what you feel is, about corporate engagement since you're in the receiving end.
Right. I think the most important thing is that we are benefiting a lot, and it's an opportunity to share what we're doing. And I want to really thank Fullerton Fund Management for having taking the lead to organize this conference. I think this is a great platform where corporates and yourselves, fund managers and all others are able to come and share with the entire ecosystem. And I believe that it is important to tackle climate change, to have all players come together and think about solutions of the future.
Yeah, so that wraps up our session, and thank you so much for our two expert panelists for coming in. We saw on the poll that actually a lot of the audience thinks that Asian companies can do a lot more, and I hope that these two examples in a panel will actually show you that we are striving all towards a net zero future. Thank you.